Every 30 years or so, American investors convince themselves they've discovered a new era of permanent prosperity. 1999 had the dot-com boom. 1970 had the Nifty 50. And right now, in early 2026, I'm watching it happen again with artificial intelligence. But here's what nobody's telling you. The once every 30 years event you need to worry about isn't the bubble itself. It's what you're about to do when it pops. And I can predict with near certainty what that'll be because I watched your generation do it last time. You're going to try to time the market. You're going to think you're smarter than the system, and you're going to be catastrophically wrong exactly when you can least afford it. I'm going to walk you through why 2026 is genuinely unprecedented. Not because of AI hype, but because three separate 30-year cycles are colliding at exactly the same moment. And I'm going to show you the mathematical reality of why the thing you think will save you, moving your money at the right time, requires you to be correct not once, not twice, but 6 different times in a row. The odds are worse than playing roulette. Think of the stock market like a crowded theater. Most of the time, everyone's watching the show, sitting in their seats. Then somebody yells fire. Now, it doesn't matter if there's actually a fire. What matters is whether you believe there's a fire. Because the moment you stand up to leave, you're not making a financial decision anymore. You're making an emotional one. And here's the thing about crowded theaters. The people who panic first and run for the exits, they're usually the ones who get trampled. Let me tell you about my neighbor Frank. Retired in 2000, had about $400,000 in his 401k. On March 10th, 2000, the NASDAQ hit its peak. Frank didn't sell. He wasn't worried. But then it dropped and kept dropping. By October 2002, he'd watched 78% of his tech holdings evaporate. So Frank did what seemed logical. He sold everything, moved it to treasury bonds. Except, here's what happened next. The market bottomed in October 2002. Then it rallied. By 2007, the S&P 500 had recovered completely. Frank's bonds, they earned him maybe 4% annually, while inflation ate 3% of it. He lost 5 years of compounding he'll never get back. Not because he was in the market when it crashed, but because he left right when he should have stayed. Now, 2026 is what's called a midterm election year. And historically, midterm years are disastrous for stocks. Between 1900 and 2024, midterm election years averaged just 0.78% gains. Compare that to primary election years, which averaged almost 9%. This isn't conspiracy theory. It's fiscal and monetary policy reality. Administrations make unpopular decisions early in their terms. The consequences show up in year 2. But you know what else is happening right now? More than 11,200 Americans are turning 65 every single day from 2024 through 2027. Your entire generation hitting retirement age at once. And here's the uncomfortable part. About 53% of peak boomers have less than $250,000 in total assets. That's not retirement money. That's panic money. Money that makes you do stupid things when markets wobble. So we've got 3 cycles converging. A tech bubble that rhymes with 2000, a political cycle that historically produces the worst market year, and a demographic time bomb of underfunded retirees who can't afford to lose anything, which means they're primed to make emotional decisions at precisely the wrong moment. Here's where it gets really interesting. Let's say you're right. Let's say you somehow know the market's going to crash this year. You decide to sell. Smart move, right? Wrong. Because now you've created a much harder problem. You don't just need to know when to sell. You need to know where to put that money, how much to move, and exactly when to buy back in. Research from 2024 found that investors timed their buy and sell decisions correctly only 25% of the time. That means they were wrong 3 out of 4 attempts. Think about what that means. A professional fund manager, someone who's paid $500,000 a year to make these decisions, someone with teams of analysts and real-time data feeds, gets it right maybe 55% of the time. You, reading market headlines and watching financial YouTube, think you're going to beat that? The math doesn't work. The incentives don't work. The psychology definitely doesn't work. There's this old story about a trader who worked through the 2008 financial crisis. Markets were in free fall. The S&P 500 dropped almost 20% in a single week that April, just a few months ago in our timeline. Everyone was selling. This trader's phone was ringing off the hook, clients screaming at him to get them out. He had this policy though. He'd ask one question, "Where do you want me to put it?" And nobody had an answer. Because here's what people don't understand. Selling doesn't solve the problem. It just creates a new one. Now you're sitting in cash, watching inflation eat 4% a year, and you need to guess when to get back in. Except you won't, because when the market starts recovering, you'll be too scared it's a false rally. The research is brutal on this. Even investors with the worst possible timing, people who invested at the market peak every single year, still beat the people who stayed in cash entirely over 20-year periods. Procrastination turned out to be more expensive than catastrophically bad luck. Now you might be thinking, but this time is different. AI is a real bubble. The valuations are insane. And you know what? You might be right. But being right about the diagnosis doesn't mean you'll survive the treatment. Let me give you a concrete example. Let's say you've got $500,000 in your retirement account right now. You think the market's going to drop 20% this year, so you sell everything. Move to treasury bonds paying 4%. Market drops exactly like you predicted, 20%. You feel like a genius. Except now what? The market's down 20%. Do you buy back in? Well, it might drop another 10%. So you wait. You wait another month, another quarter, and then one morning you wake up and the market's up 8% in 3 weeks. Do you buy now? Or is this a false rally? By the time you're confident enough to reinvest, the market's back to where it was when you sold. Except you've been sitting in bonds earning 4% instead of getting those dividend payments. And you've probably paid taxes on the sale if this wasn't in a retirement account. You were right about the crash. You still lost money. One Wall Street analyst is calling for a 65% chance of a bear market in 2026 with average losses of 20%. Sounds terrifying, right? Except notice the phrasing. 65% chance means there's still a 35% chance he's completely wrong. And average losses of 20% means some sectors might drop 5% while others drop 40%. Which ones? He doesn't say, because he doesn't know. Here's my favorite part about all these predictions. The 10 biggest daily moves in the S&P 500 over the past 30 years have all occurred in the last 5 years. The market's not following the old patterns anymore. It moves faster, crashes faster, recovers faster. Which means even if you somehow time the exit perfectly, you'll probably miss the recovery entirely because it'll happen before you build up the courage to buy back in. Let me tell you about the Fidelity study. They wanted to know which investors performed best. So they analyzed all their accounts. The top performers, the ones who beat the market consistently, had something in common. They were either dead or had forgotten they had the account. I'm not joking. The best investment strategy was literally to be unable to access your account and meddle with it, because every time you touch it, you make it worse. Now here's the mechanism that destroys you. It's not complexity, it's sequence. To successfully time the market, you need to get 6 things right in order. First, identify the signal. Okay, you think valuations are high? That's easy. Second, time your exit to the day. Miss by a week and you've left gains on the table. Third, pick the right alternative asset. Maybe bonds, maybe gold, maybe cash. Which one? Fourth, time your re-entry to the day, because the biggest up days always come right after the biggest down days. Fifth, decide how much to move. All in, 50%, 20%. The wrong allocation turns a winning call into a losing one. And sixth, account for all cost, taxes, trading fees, opportunity cost, the drag from holding cash. Get one wrong, the whole thing falls apart. Get 2 wrong, you're worse off than if you'd done nothing. The professional traders who do this for a living get maybe 3 of the 6 right with any consistency. But here's what really kills me. More than half of baby boomers turning 65 between 2024 and 2030 have assets of $250,000 or less. Nearly 2/3 have $500,000 or less. You know what that means? Most of your generation is walking into retirement with barely enough, assuming the market cooperates. You don't have margin for error. You can't afford to be out of the market during the recovery years. And yet, that's exactly when fear will tell you to sell. There's a reason Warren Buffett says never bet against America. Not because America's perfect, because betting against it means you have to be right about when to get out and when to get back in. Buffett's entire fortune comes from buying and holding, from sitting through crashes and letting compounding do the work. The man's got over $100 billion. You think he doesn't know something you don't? Here's what you actually need to do. 3 things. First, know how much money you need in the next 5 years. Put that in something stable, not because you're timing the market, because you're matching your liquidity needs to your timeline. Can't retire on hope. Second, everything else, stay invested, globally diversified, not just US tech stocks. Real diversification. If US goes down, maybe international picks up slack, maybe bonds hedge, maybe real assets hold value. You're not predicting, you're preparing for multiple scenarios. Third, automate your response to crashes. I mean, literally write down right now what you'll do if your portfolio drops 20%. Because if you wait until it happens to decide, fear makes the decision for you. And fear is expensive. You want to know the most expensive sentence in investing? I'll get back in when things stabilize. Things never stabilize. They just move from one crisis to the next. If you wait for calm, you wait forever. 2026 is going to be wild. The political cycle says it'll be rough. The demographic cycle says there's going to be panic selling. The technology cycle says we might be in bubble territory. All probably true. And none of it matters to your decision making because you're not playing a 6-month game. You're playing a 20-year game. And in 20-year games, the only people who lose are the ones who leave. So when the crash comes, and I think something probably will shake loose this year, your job is simple. Do nothing. Check that you've got enough cash for near-term needs. Rebalance if you're more than 5% off your target allocation. And then close your laptop and go do something else. The theater's not on fire, people are just yelling, and the ones who get trampled are the ones who run.